Hello and welcome to my crypto brief. Today's video is titled Gold and Beyond in Crypto, Bridging Centuries Old Value with Cutting Edge Technology. And in today's video we're going to look at the gold price. We're going to compare different tokenized products, precious metal products. We're going to look at earning yield, the current DeFi status and certain risks involved in owning such tokens. Let's get started. So why gold matters today? And potentially a more interesting question might be, should we buy gold today or continue buying gold today? Obviously we should have bought gold over the past couple of years, but will gold continue its run? I guess we'll have to wait and see. Anyway, why gold matters today? Gold has served as a store of value historically and has been used as a hedge against inflation for centuries, or at least since we came off the gold standard. Currently, there's multiple factors driving the surge in price. Let's run through some of them. There's the US tariff and trade wars, geopolitical tensions, mainly between the US and several countries around the world, the Greenland situation, China trade wars and whatnot. There's de-dollarization. A lot of countries are choosing to purchase oil, for example, in different currencies other than the dollar. And there's the BRICS currency as well, which might start replacing the dollar for international trade. I think we touched on that in a previous video. There's persistent inflation, and also very importantly, the aggressive central bank buying. There's a lot of people actually speculating that China's been buying a lot more gold than they have been reporting. So the gold price is trending towards $5,000 per ounce. Last I checked, as you can see on the chart here, maybe if you squint your eyes, is $4,945. So while I'm making this video, potentially gold could be breaking above the $5,000 mark. So we have two charts in front of us here. The first is the spot gold chart in dollars. And we can see from the 1970s that we've done over 100x from $30, $40 up to $5,000, almost $5,000. Some years gold has made huge gains. And then we've had maybe a slow decline, slow bear market from in the 1980s, 1990s, followed by another huge bull market. And currently we're in a bull market and we don't know when it will stop. I don't believe we have any reason to expect it to stop right now, especially with all the geopolitical tensions in the world. But I guess we never know. And the next chart we have is the Bitcoin gold chart. So Bitcoin priced in terms of gold. Just as a note, this chart is a monthly chart, so monthly candles, and the time period is about 15 years, whereas the last chart is yearly candles, and its time period is about 60 years or so. Anyway, if we look at the Bitcoin gold chart, we can see that Bitcoin has had a good run against gold, while gold has also been having a good run against the dollar. But in recent times, it looks like Bitcoin has started to struggle, started to top out. Over the past 5 years, we could kind of be described as going sidewards, maybe just up and down in the same range is a better way to describe it. But we're at the same price levels that we were back in 2021. Bitcoin did put in a higher high against gold last year, but it was only a slightly higher high, which isn't really a great sign for Bitcoin. Bitcoin's moving into its bear market year. I guess it's been in its bear market year for the past 3 months. So we potentially have another 9 months left of Bitcoin trending downwards, whereas gold seems to be continuing its multi-year bull market. I guess levels to look out for to convert gold into Bitcoin would be in and around the low of 2022, potentially a little bit higher. Hopefully we would put in a higher high, a higher low against gold. And potentially now is a good time to convert Bitcoin to gold, potentially. Obviously, I don't know what's going to happen, but I'm kind of leaning towards that way. Obviously, not financial advice. The best time to convert would have been a couple of months ago when, or maybe last year when Bitcoin did put in its new all-time high against gold, obviously. Moving along, the rise of tokenization and what it means. So this video is about tokenized precious metals, but I thought before we move on to that, it makes sense to do a quick overview of what tokenization actually is. And the definition is converting rights to real-world assets into digital blockchain tokens. And them real-world assets can be anything like precious metals that we're looking at today, real estate, bonds, stocks, art. It could be royalties to a piece of music. It could be a computer game or even items within a computer game. Quite a wide range of things can be tokenized, and it's expected to be a huge industry in the future. But why do we even want to tokenize the rights to these real-world assets? The first reason we have here is for programmability. And programmability actually enables quite a range of features. Let's run through a couple. So programmability allows assets to be locked away into certain DeFi smart contracts to earn yields and to lend and borrow and other such things. It enables people to trade these assets peer-to-peer without any centralized third parties. It enables automated transactions, and transactions which are automated when certain conditions are met, for example, potentially wills. And it enables the rights to these assets to be divided up into potentially thousands or even millions of pieces, whereas it would be impossible to divide an ounce of gold, say, into 1,000 equal pieces. It becomes very possible when we tokenize that ounce of gold. So having these programmable tokens, as we already touched on, enables 24/7 trading outside of market hours without needing centralized third parties. It enables composability, which is seamless integration with DeFi protocols as well, we already kind of touched on. And finally, having these tokens on the blockchain enables transparency. So a blockchain is actually a database, generally public, unless it's a privacy blockchain. And that enables trust in the system. It enables audits and verifiable proof of reserves and transactions and other things like that. And here are our tokenized gold projects in question. So we have PAX Gold, Tether Gold, and Kinesis Gold. PAX being the largest market cap with 1.2 billion. Tether then with 800 million, and Kinesis then with 150 million, the smallest of our projects. They're all backed 1-to-1 with physical gold, although PAX and Tether Gold both track a Tory ounce, whereas Kinesis Gold tracks 1 gram or is pegged to 1 gram. So each project does allow you to redeem the token for the actual physical bar of gold. However, there is a limit, a minimum amount of gold that you can redeem, and it looks like PAX is the winner, and potentially this is the reason for it having the largest market cap. So PAX Gold requires you to redeem a minimum of 1 ounce, which is roughly $5,000 at the minute, whereas Tether requires a minimum of about 430 ounces, which is over $2 million worth of gold. And Kinesis requires 100 grams minimum, which would be 100 tokens, which I think is 3 or 4 ounces, and that would come in at around $15,000 to $20,000. PAX stores its gold in Brinks Vaults in London. Teller stores its gold in Swiss Vaults, and Kinesis stores its gold with ABX. It has a series of vaults, a network of vaults around the world. PAX has monthly audits, Teller quarterly audits, and Kinesis bi-yearly audits. PAX and Teller do not offer any yield on holdings, and Kinesis do. Last year, there was a 4% yield. Last month, however, there was only a 0.02% yield, and if that amount was to hold, then for the following year, you would only get slightly more than 0.25% on holdings, which is better than nothing. And that yield comes from people paying transaction fees on their platform, presumably from minting and redeeming their token. We already looked at the market cap. Networks, PAX, Teller, and Kinesis all run on Ethereum. Teller runs on Tron and Ton as well, Ton being the Telegram network. And Kinesis supports, it looks like supports direct deposits of Bitcoin and Ethereum to minted token, presumably. I guess they're all regulatory compliant, and disappointingly, they all have the ability to freeze your holdings. This is disappointing. Crypto kind of prides itself on permissionless transactions. However, I guess if you were to hold your gold in a TradFi system like an ETF, they would also have the ability to freeze your assets. The only way around that, I guess, is to buy the physical stuff. But it's not just gold tokenized on the blockchain. We also have Kinesis Silver, Aurora's Plat, a tokenized platinum product, and Palladium coin, tokenized Palladium. They're all redeemable for the underlying physical asset at different minimum values, and they're all periodically audited. Kinesis Silver also offers a monthly yield, and all of these assets are, again, freezable, unfortunately. A word of caution, Aurora's Plat and Palladium coin, and to a lesser extent as well, Kinesis Silver, are all small market cap tokens. So it could be quite hard for them to hold the peg, and potentially if liquidity dries up, you may not be able to sell them online. You might need to redeem them for the underlying asset, which could leave you stuck with a couple of bars of platinum. So let's say you want to buy some precious metals. Well, now you have 3 options. You can buy the tokenized stuff on the blockchain. You can buy the traditional ETFs on the stock market, or you can buy the physical stuff. Let's say you buy the tokenized metal. Well, now you can trade it 24/7. You can buy and sell fractional amounts of it, so you don't need to buy and sell a full ounce or a full gram or a full share of it. It can be sent across the world instantly. There's 0 storage fees, and it can be used in DeFi to generate yield, to lend out, or to borrow against. However, holding tokenized metals does carry with it some depegging risk, and that's when the value of the token no longer tracks the value of the underlying asset. Now, the fact that the token is redeemable for the underlying asset, provided you meet the minimum requirements, the depegging shouldn't really happen. But if there's fear in the market and people start to think that they're not going to be able to redeem their full amount of underlying asset for the token, then that price can slip. There's also counterparty and regulatory risk, Although if the companies are audited and the custodians of the physical assets are audited, then that should mitigate that risk as well. Your next option is to buy shares in a traditional ETF, and that restricts you somewhat. You can only buy and sell shares during market hours, and you can't buy fractional shares, so you're restricted to buying whole shares only. With the ETFs, there's higher liquidity, so you shouldn't have a problem when it comes time to sell, which you might have with some smaller cap tokens. There's management fees built into the shares, so the shares will devalue at, here it gives an example of 0.04%, which I believe is roughly about right. So the shares will devalue at roughly about 0.04% per year to cover management fees. With some ETFs, they're not redeemable for the underlying assets, and some are. So if you are buying ETFs, you might want to ensure that the ones you buy are redeemable. And similar to depegging risk, sometimes there are fund tracking errors, but generally they are short-lived. And your final option is to buy the physical metal. And there are a lot of different ways to buy the physical metal. I guess the most common is to go to one of these websites where you order the metal and they deliver it to you. Generally, you'll pay above spot price because of delivery and insurance. There's also, obviously you can buy jewelry. A lot of people would go to auctions and try and buy the metal at scrap value. And I guess some people also advertise on online market platforms and buy and sell the metals peer-to-peer. Then there's the problem of storing the precious metal. Some people will pay 1 or 2% annually to store it in a vault, and other people will find places around their own properties to store it and run the risk of theft or storage blunders. If you do buy the tokenized metal, you can use it as collateral for a loan, or you can lend it out and earn yield on it. And there are cross-chain bridges to move it between different networks, so you can use different DeFi platforms on different networks. So now we're going to look at some of the risks and challenges to consider when using these precious metal tokens. We've covered some of these already, but we'll just run through them again if we have. So there's KYC and AML compliance requirements that vary globally. A lot of different countries have fraud protection laws, and there can be a bit of a complex compliance landscape depending on where you live. There's counterparty risk, so you'll want to trust the issuer of the token you're buying and the custodian and vault operators that are holding the underlying asset. This is why audits by third-party companies are important. There are certain market risks involved. For example, small market cap coins don't take that much buying and selling pressure to move the price, which means that quite frequently you can get a premium or a discount to the spot price. As well, if it's a small market cap token, sometimes you can be left without any buy pressure at all when it comes to selling, which means that you're unable to sell your token. Also, if you've used your token for collateral in a smart contract for a loan, Oracle vulnerabilities that provide the smart contract a price feed can cause liquidations when one shouldn't occur. And there are several security concerns you should be aware of. So first of all, a lot of crypto exchanges have been hacked. The best place for your crypto is off an exchange and on a hardware wallet. Secondly, a lot of smart contracts are exploited. So if you're using any DeFi protocols or cross-chain bridges, please make sure they're built by reliable, qualified engineers. And thirdly, a lot of investors in this space aren't that tax savvy, and scammers take advantage of this. So if anyone asks you to send them crypto or your seed phrase for any reason, the chances are it's a scam. So please be aware of that. But regardless of the risks, a lot of people see great potential in the future of tokenized real-world assets. The CEO of Hystacks predicts a 400 billion plus market by the end of 2026 and a $1 trillion plus potential by the end of 2030, which is a huge step up from the current market of 21 billion. Today we discussed PAXG and Teller Gold, and they lead the way in the tokenized precious metal space. But there's huge potential for a lot of other real-world assets to end up tokenized on the blockchain and traded worldwide 24/7, such as real estate, bonds, stocks, commodities, art. This could just be the tip of the iceberg. Thanks for watching. If you enjoyed the video, please click the like button. If you want to see more, please subscribe to the channel. And if you have any suggestions, please let me know in the comments below. Bye now.